let's talk about sell to cover RSUs. So this is a popular offering if you work at a company that grants RSUs. It's part of your compensation package. This is awesome. A lot of employees who work in tech or at really any public company have come to expect RSUs as part of their compensation packages. Now, with compensation comes taxes, of course. And here at Brooklyn FI, we're not afraid of taxes. We just want to get ahead of them. We want to understand what our tax obligation or liability or bill is going to be, so that way we don't get hit with any surprises. And using this strategy called sell to cover RSUs is a great way to avoid a surprise tax bill. And basically what we're talking about is as your grant of RSUs vests, meaning you're working at the company and you're receiving a set amount of shares, sometimes it's monthly, sometimes it's quarterly, sometimes it's annually. When you receive those shares, it's income to you. Now, most of the time, your employer is going to sell some of those shares to cover the taxes that are owed. So if it was a regular paycheck and you were getting cash compensation, you look at your paycheck, you don't get that full value of that salary, right? They withhold some of those dollars back to cover federal tax, state tax, Social Security, yada, yada, yada. So same concept here with RSUs. So as they vest, you're receiving shares, not cash, and the company is going to hold back some of those shares. They're going to go sell them to the market and cover the taxes that you owe. Because remember, RSUs are ordinary income. So even though they are shares of your company, they're lumped in with that same paycheck salary. So you're going to owe a similar tax rate on them. There's some complexity here with your actual withholding rate. So we run into a little bit of an issue if we're selling a certain number of shares to cover our tax liability, but our actual tax liability could be higher. So that could be an issue for you. Really important to understand what that tax bill is going to be, so we can make sure that we don't have any surprises. And that's pretty much the basics of sell to cover RSUs. Just a quick example. So for example, we've got Emily here. She's got RSUs vesting over 4 years. Her tax withholding rate is 25%. She's got shares vesting at $20, and there's 200 RSUs vesting. So to keep it really simple, she's getting the value of $4,000 of income, and her tax rate's 25%. So she's going to owe $1,000. So that company is going to sell $1,000 worth of those shares of stock to cover that $1,000 tax liability. So she's going to receive fewer shares because they withheld some of them for taxes. I think this is a great strategy. Again, we want to avoid all surprises when it comes to taxes. Thanks for watching.